Please, can we all take off our videos, please?
Ẹ pa àwọn kámẹ́rà yìí á ti rí yín. Ó
I
ga
don't
o.
understand though. Let me ask them. Please put off your cameras. Thank you.
èèyàn fẹ́ pa kámẹ́rà wọn ẹ pa kámẹ́rà wọn.
Mr. Ngozi, Madam Ngozi, please off your camera.
A ti rí
Bolaji,
yín
off your
sójú
camera.
láàfẹ́ o. They show yourself
Ngozi,
o.
we have seen you, we have seen you. Take care. Off your camera.
We can see you are beautiful and handsome.
How can someone be beautiful and handsome at the same time?
I'm referring to male and female at the same time.
So you're calling me Bobrisky, Abi?
Oh, sue me.
Good evening, guys. Please, can you hear me?
We can hear you, sir. Good evening, sir.
Where do we start from today, guys?
The arrival of Oluwaye of SFM. Mogbola himself.
Well, I will now. Anything people say in this class.
Ọmọge sí
I don't
ni.
hear.
Ọkọ gbogbo ọmọge.
No one.
His
Anything.
Excellency, Jagaban of SFM, welcome to class.
Yeah, no problem. I said, Shane, does anybody want to wine me again before I get started? Nobody. Thank you very much. So I can start.
ọ̀gá ọ̀gá àwọn ọ̀gá ńlá.
No problem. You are doing well. Hey, no, Allah. Let's get to the business of the day, please. Thank you very much. Good evening, good evening to everyone once again. Very sorry for coming late. Very, very sorry. I slept off. I will not even lie. I said, let me just close my eyes. Before I know, I don't sleep off. Very tired. So don't ever don't be angry. But you know the thing, me, I can sleep anytime I like and I can wake up anytime I like, but you guys cannot. Yes, now. It was any of you that slept off like that. Guilty conscience will not allow you to sleep. And I have exam November, and I'm still sleeping like this. But me, I don't. I can sleep, wake up, do anything I like at any time I like it. Because why? Because there's AC at the back of my name. But it's not at the back of your own name. It's at the back of my name. Sulaiman Olanshele Omobola, ACA, ACS. Still get ACC. You don't have anyone. I'm sorry. It's not my fault. It's not my fault. When you have, come and talk to me. We'll be in the same shoes then. But for now, I can still sleep and wake up. Anyways, let's get to the business of the day. First of all, I would still like to apologize again for last class. I think our last class was a little bit messy and I had an engagement, so I was quite rushing. So I know it was a little bit here and there. It wasn't the best after all. So I just decided to apologize for that. I think I rewatched the video and I did not really like the way it turned out. I rushed too much. Although I still have an engagement for 7 today, but I think I will take my time a little. So I might be very sorry for that too. But regardless, let's fire on. Let's fire on for today. Now let me do a little bit of a recap of the things I spoke about. Or is there any question? Is there any question anyone wants to ask me regarding anything we've done? Last class basically. Is there any question? Please don't ask me to solve that question again, please. And I think I forgot to send the working note. Sorry, I forgot. But anyways, I'll send it together today. Is there any question? Does anyone have any question to ask me, please? No question, yeah?
No question, sir.
Favor, talk to me, please.
Okay, sir. My question when I was solving sorry, good evening, sir. So when I was solving the MIRR, I discovered when I checked the past question, though I solved mine differently. Yeah, so I saw that they did not like do the normal MIRR thing. They just used the normal PV of inflow, then divided it by outflow and all that. But the one you taught us, basically, we are like going to like do I thought we were going to like do all the working capital as well. I don't know if you understand.
Okay.
Yes, like
No.
when there's a question you solve when you did the first year, like the normal initial outlay, there's a question that the question had a working capital for the first year. So we also like discounted our working capital. So
For
since I don't
MIR, no be me
yes.
teach you that one.
So
No be me.
basically, all right, no problem, sir.
I think you're mixing it. Maybe your other center is not me. Because
I don't.
I remember that even the first day I was saying the assumptions of working capital, I made it very, very clear. And I stated some little things about working capital. You don't tax it beginning of the year, but for MIRR, you are never going to use working capital. I told you there were two methods to do MIRR. There's one very, very, very big formula. That one that will allow you, that will involve you doing you will do to perpetuity to terminal, all those. And I told you particularly that I don't want to give you that one because that one is a little bit complicated. Let's just do PV of cash inflow over PV of cash outflow, 1 minus 1 raised by 1 over n, and all those things. That was the formula I gave. That's the formula I expected. So if that was the one you used for that last question, I think it would have worked. Just pick after you've discounted, just pick all the cash inflow over cash outflow, 1 minus, do that formula. I think it would have been very easy. You don't need to do anything relating to working capital when it comes to MIR. The only reason why you might want to do working capital and all those things again is in the question, if you were not asked to determine MPV, it's just MIR straight. You will do from beginning. I don't know if I'm making sense. What I'm saying is, if they ask you to do MIR, no MPV, just MIR, obviously you will need to get PV of cash inflow now, and you need to do PV of cash outflow. So it means that you would have done the sales, the variable cost, the working capital, the tax savings to get your PV, to get your total cash inflow, and to also get your total cash outflow before you will now discount it so that you will not get PV of cash. That's the only scenario that you can do all those things fresh. But in this particular question, we already did MPV. Automatically meant that we already do our sales, our variable cost, all of it. We already have our PV of cash inflow and our PV of cash outflow. Just take it, go and put it in that formula and move on. Oh, good, man.
Yes, sir.
Okay, 1 minute, please. Let me change my internet. 1 minute. I'm here. So no other question apart from that one, yeah? Okay. Oh, yeah. Let's continue then. Now, I need Miss Fetty, are you there? Miss Fetty, are you there? Okay, she isn't. Let me look for one of my regular students. I want to announce something, but I need Miss Amaka, are you there?
Yes, sir.
Okay. Thank you very much. So I need you to do something for me. So I want to what's the name now? I want to do introduction to adjusted present value again. Do you understand? So but I need you to keep me in check. I just want to do it for 30 minutes, then maybe I'll solve a question for 1 hour 30 minutes. I just want to do the explanation for 30 minutes. So I need you to keep me in check. I need to keep me in check for that 30 minutes. Please, are we good?
Your time starts now, 5 p.m. on the dot.
Only my time starts now. It won't be my time starts now. No, you give me time. Hey, no problem. Thank you very much. But please, not 5:30.
Okay, sir.
Oh, yeah. Now, listen to me. Now, when it comes to adjusted present value, see, it's not hard. Honestly, it's actually not hard. The only thing about adjusted present value is you just need to pay attention to details. Pay attention to details and understand the background. I don't know if people know or people don't know. There are some pilot questions that are going around that I can drop pilot questions, whatever, blah, 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 blah. Unfortunately, I'll be able to look at the two or one of them, and I saw APV there. So for APV to be in that question, it's no longer I can have tested APV. So it means we can be expecting something. There's a chance of us expecting something. So you need to understand what we are trying to do when it comes to adjusted present value. Now, this is what we are doing. Now, for adjusted present value, I already explained to you the other day that the assumption or the belief is the business risk of this particular, I don't know, I think I made a mistake when I was saying this in the last class. But the assumption of APV is the business risk of the company is not changing, but the financial risk is changing. That is the assumption. Now, but the thing is still that APV just assumes or believes that whenever you want to finance the new investments that you want to do, whenever you want to finance the business you want to go into, there should not be debt. That is just APV's assumption. It's an assumption that there should not be debt. Now, the circumstances is now that Listen, no, that is this APV's assumption that there should not be debt. You should not finance the new investment with debt. But the thing is, there is no way. You don't have the money now, so you would still not go and finance it with debt. That is why the formula for APV is your base case MPV plus or minus the PV of the financing effect. That is, you have now gone to collect the money that we say you should not collect, Abi. The effect of you now collecting that money, we will now add it to the base case MPV. I don't know if I'm making sense. We said don't collect money, that's APV. Don't go and borrow money. But because you have to head, you have stronger, you said no, I will borrow money. You've now gone to borrow money. Fine. The effect of you now borrowing money, we will now add it, we will discount it, then add it to the base case MPV. That becomes our APV. That is just what they are saying. Now, when I say businesses financial is changing, not changing, it's just for you to understand the concept. In exam, they will tell you calculate APV. As long as you have seen calculate APV, just you shall know what to do. The business's financial risk is not your business then. Do you understand? It's not your business. As long as you've seen calculate APV, you know the next thing to do. Now, listen up. So the formula for APV is now your base case NPV plus or minus the PV of the PV of financing effect. That's the formula for APV. Now, there are some things you need to take note. Please, there are some things you need to take note when it comes to adjusted present value. Now, what you need to, okay, let me share my screen so that I can properly display what I'm saying. Let me share my screen. I'm assuming everyone can see my screen. Please, can you all see my screen, please?
Yes,
Thank you
sir.
very much. Okay, so let's fire on. So as I was saying, the question will tell you that do APV. So once you have seen do APV, fine, there is no problem. This is just what you just need to do. First of all, you need to do the base case NPV. What's the meaning of the base case NPV? The usual NPV that we've been doing. That is your sales less your variable cost, less your fixed cost, get your profit, do your tax if your tax is in arrears, if your tax is in actual year, do your tax savings if your tax is in actual year, your tax savings will also be in actual year. If your tax is in arrears, your tax savings will also be in arrears. You do your working capital, do your initial outlay, your scrap value, get your what do you get there? Get your net cash flow. Listen, get your net cash flow. But this is now where the trick starts from MPV. The moment you've gotten your cash flow, please, when you get to your discount factor, don't discount with your work. Oh, are you listening to me? Don't discount with your work. What do you discount with? You will discount your adjusted present value with your cost of equity. Your cost of equity ungeared. Do not discount with work. Questions will give you work. If you carry that work and go and use it, total law. Don't discount with your work. Go and discount with your cost of equity ungeared. Now, what is the meaning of cost of equity ungeared? What I'm saying is, when it comes to cost of equity, come on, see as I the flow. Some of you now, your mind will be like, God, when me say go here explain SFM like this, no worry, you get there, don't worry. It's not rocket science. It's not juju. It's not juju. You know, it not come one day. Don't worry, it's not juju. So as I was saying, you will use your cost of equity ungeared. So the first one, assuming that in the question they gave you, say, equity beta, asset beta. So I'm going to explain those two things. So they give you equity beta in the question, like equity beta of your proxy company, and you understand. And the way we used to do a normal project-specific cost of capital, you first identify the proxy company. After you identify the proxy company, you identify the proxy company's equity beta. Now, the beta is it equity beta or asset beta? Good. If I was given to you the question is equity beta, you ungear. Now, what I'm not saying is when it comes to adjusted present value, the moment you ungear to get your BA, stop gear. But don't re-gear when it comes to adjusted present value. You will not. It makes sense now. Don't forget what I said. The assumption is you are not borrowing money, and when you ungear, you are removing the financial risk of your own you are removing the financial risk of the proxy company now, so that it's left with just their businesses. And why do you now want to incorporate your own business? Why do you know that when you ungear, you are removing the proxy company's financial risk, Abi, and when you re-gear, you are incorporating your own company's financial risk. What I'm now saying is, since APV is of the assumption that we are not borrowing money, and we have ungeared to remove the proxy company's financial risk, that means we don't need to incorporate our own financial risk again now. So people say we are not borrowing money. So we don't need to incorporate our own financial risk again. So you will not gear. Once you have ungeared and you've gotten your BA, that BA that you've gotten, go and put it in your CAPEM formula. That is your risk-free plus. That B now open bracket RA minus RA. That thing that is used to get your cost of equity. And meant to get your cost of equity, bam, take that cost of equity. Why is it to discount? Why is it to discount your base case MPV? That's the first scenario. I saw another question in another scenario where beta is not given to you in the question. I think it was, I don't know the diet, but there can be a scenario where you don't even have beta. Or it's not even only beta that you don't have. You don't even have information for CAPEM. Yes, now. You don't even have information for CAPEM. You don't have risk-free, you don't have risk premium, you don't have beta. And you need to discount. Some of you will say, since I didn't go and use WACC, you still will not use WACC. You will still use your cost of equity on GET. What do you now do there? You will now use something we call KEL. Let's call it KEL formula. But the normal one is M&M, your Milan Modigliani. You're not going to use Milan Modigliani formula. For me, I used to call it KEL. It's called KEL formula. But KEL, so you use KEL in a question where you do not see where there is no beta or there is no CAPEM to get your cost of equity on GET. You can use it to get your cost of equity geared to anyone. You can use it for geared or ungeared, anyone. So if you don't, so I'm telling you now, if you don't find beta, you don't find risk free, you don't find risk premium in the question, you can use your Miller and Modigliani formula. What's your M&M formula? Your M&M, I know some of you don't know it. Some of you are even hearing for the first time. Your M&M is saying that, your M&M is saying that, let me do it like this, saying that your cost of equity geared, is equal to your cost of equity ungeared, sorry, because your cost of equity ungeared plus what's that from plus cost of equity ungeared again minus your cost of debt times, I think this one is at the back of that your question, I cannot exactly remember, times debt post tax times debt post tax over your equity. This is your Milan Modigliani formula. You see that looking at this just right on top of your head, there is no beta, no risk free, no risk premium. Majority of the things here will be provided for you in the question. Your cost of equity on GET. So it depends on the one you are trying to look for. If it's your cost of equity GET that you're trying to look for, you can use it here. So you can just use it straight away like this. But if it's your cost of equity on GET that you're looking for, you can also just use it. So you would not make cost of equity on GET. So I think there's a question or a question mark. I cannot put that will do something like this. So you can also now do, you will make this scale subject of formula ahead, then you do normal mathematics now so that you get your cost of equity on GET. That's why if you don't have information for beta, if you don't have information for what's the name, for market risk, market premium, I think when I'm solving, I think I will solve a question and I will use this one. And that's for discounting formula. So this PV of financing effect. Let me move down a little. So this PV of financing effect, this is where the work is. This is where majority of the work is. Now, PV of financing effect, listen to me. PV of financing effect is broken down into PV of issue cost. Or let me just say it's broken down to issue cost, interest, and subsidy. It's broken down into issue cost, interest, and subsidy. Now let me start. When it comes to issue cost, now what's the meaning of issue cost? Issue cost simply means they are just basically their costs that are basically, how would I explain it? They are associated with you issuing either debt or equity. They are costs that are associated with you issuing either debt, or it can be anyone. They are costs associated with issuing debt and equity. Let me put it like that. What I'm saying is, when you want to go and collect money, either an equity or debt, you will pay some fees now. You pay, maybe you want to recheck your book. You will pay audit fees. Sometimes you will pay legal fees, marketing expenses, registration fees. All those things are called issue costs. They are costs that are relating to the issuance of debt or equity. That's what we refer to as issue costs. Now, listen to me. I will break them down one by one, and I will tell you the circumstances and the problem with each of them. That is issue cost. Now, the challenge with issue cost is normally, normally in every cases, issue cost should always be charged on your gross finance raised. It should always be charged on your gross finance raised. But in the question, you will most likely be given gross finance required. Now, what you should be on your mind is this man just tell me things where I don't know. Which one be gross finance required? Which one be gross finance raised by? I never hear all this one before. Yeah, calm down. Don't panic. I'm here for you. Now, gross finance required. What it means is, there can be sometimes, let's say I want to go into real estate business. I need what is required for that business is 100 million. But because I be hustling boy, I can get equity, I can get debt as soon as possible. I raised 150 million. Listen to me, what was required is 100 million, but I raised 150 million is different. What is required is 100, what I raised is 150 is all different. So now in this particular scenario, that 150 million is what your issued cost should be on. It is what your issue cost should be on. It should be on the gross finance raised, not on the gross finance required. Is the total now? It's total that you raised now. So that amount, that total issue cost should be on it. But note, questions will determine what you will do. Question will tell you that, okay, issue cost is on the gross finance required. They say issue cost is on gross finance raised. The question will tell you. If it's on the gross, so what I'm saying, normally, in a normal scenario, it should be on gross finance raised. But if examiners say do it on gross finance required, please do it on the gross finance required. Let me explain it in the question. The question will say, okay, issue cost is 2% of gross finance required, or issue cost is 2% of gross finance raised. Do you understand? So you would just take 2%. If it's gross finance required, charge it there. If it's gross finance, charge it there. Could you be law? It's not more than that. But the only challenge now is what will be provided for you is just gross finance required. You don't have gross finance raised in the question. I don't know if I'm making sense. What you will have is just gross finance required. You don't have gross finance raised in the question. And your gross finance required self is your initial outlay. My laptop is dead here. Jesus is what? Is your initial outlay plus your working capital. Initial outlay plus your working capital. This is your gross finance required. This one obviously is in your base case MPV now, so it's in the question. But your gross finance raised is not going to be in the question. I don't know if I'm making sense now. You don't have your gross finance raised in the question, but your gross finance required is in this particular question. Now, how do you now get your gross finance? How do you now get your gross finance? If you want to get your gross finance raised, how do you now get your gross finance raised? What you are now going to do with your gross finance raised now is you will now mark it up. You understand? You will mark it up. Now, this is what we are saying. How would I explain to you that you understand that? There are situations that the issue cost is inside the gross finance raised. Listen to me, calm down. So somebody used to ask me that, so this is online, how do I used to know if my student don't understand? And this student, I'm the one talking now. When I'm talking, I can listen to myself too. So I will know when people that are listening to me don't understand. This one, some people are confused. But just listen to what I'm saying. It makes sense. It makes sense. Now, this is the way it works. Let me explain to you from this perspective. You need 150 million. So you need 100 million for a business. You need 100 million for a business. But what you're able to raise is 150 million. Now, there can be a scenario where the issue cost, that is the funds that were used to raise that amount, has been included inside that 150 million now. So that 150 million now is now a combination of the total money and the issue cost inside that total gross finance raised. Hey, that's not why we're now saying that. On a normal scenario, that issue cost should be a percentage of gross finance raised, because the assumption is inside the gross finance raised already. You get it? It's inside the gross finance raised already. So you should just take that percentage, you just remove it from it. So they will tell you 2%, 3%, just type on that gross finance raised and just remove it. That's just what we are saying. But in situation where examiner says use it on gross finance required, it's fine. Just charge that percentage on the gross finance required to and move on. And move on is what we are saying. But let me see just if you want to calculate your gross finance raised, it will not be provided to you in the question. But if you want to calculate your gross finance raised, this is what you now say. So you now say your finance, you say your finance raised, you now say equals to, we'll use this formula. You will say your finance required over the 1 minus issue cost rate. issue cost. Wait, somebody that understands mathematics very well. You understand what is happening here. If you know mathematics, you know if you went to this kind of school that I went to, you would not understand. Because with me, I went to Namina, you also. But we went to good school. All these intellectual schools that they used to call themselves intellectual nursery and primary school. Kinekon, all those big names. You understand what's happening here. We are just simply marking up now. We are simply just marking up. Now let's assume they say our issue cost rate is 4% or 2%. 1 minus 2% is about 98%. So what we are saying is we are just doing 98% of. You understand? We are just marking up to give us the gross finances. It's just basically what we are doing. It's not rocket science. SFM is simple. Just understand the basics. What we are trying to do here is just marking up this figure using that, because don't forget what I do, that is the assumption that issue cost rate is inside. And so we're just using that issue cost rate, the percentage of what is inside, to mark it up. It's just basically what we are doing. So this is how you will get this issue cost rate will be provided for you in the question. Your finance required is your initial outlay plus your working capital. If you do this, you get your gross finance. List. It's not more than this. The question will tell you what you should do. Should you use the gross finance list or should you use the gross finance required? The question would state it clearly for you. So that is on issue cost. This is number one problem on issue cost. Number two problem on issue cost, which is not usually a problem, is the difference between issue cost for debt and issue cost for equity. What that is difference is the challenge of issue cost for debt and issue cost for what? Issue cost for equity. Some questions, they will split them and tell you issue cost for debt is 2%, issue cost for equity is 1%. Now, why is it a problem? It's not a problem, but where the challenge comes from for students is, what students don't know is, when it comes to issue cost for equity, issue cost for equity, you don't relieve tax for issue cost for equity. But when it comes to issue cost of debt, you do tax relief on issue cost for debt. What I'm saying is, imagine the question says 2% of gross finance required. Assuming our gross finance required is 42 million. See our tax, see our, what is the name? See our issue cost is about, let's say 4%. So you say 0.04. This is so what I'm saying is I'm saying 4% issue cost. 4% issue cost for debt and 2% issue cost for equity. Now, what I'm saying is, for this 4% issue cost of debt, you should do a tax relief on it. But for this 2% of issue cost for equity, you don't do tax relief on it. So you will now say times 0.04. What do I have? Sharp.
1,680.
1,680.
680.
You will now come here and say 42,000 times 0.02. What do I have? Don't forget that this one will be negative now.
840.
His issue cost. His issue cost is always issue cost is an outflow. It's always an outflow, and you are going to charge it at year zero. Don't forget, it's when you are getting the money. Issue cost, when you are doing PV of issue cost, it's always at year zero. It's when you are sourcing for funds now, so it's at year zero, it's at now. So issue cost is always an outflow, please. It's an outflow. So what did you say? It is 840. Is it 840?
Yes, sir, 840.
Now, so you've done 840 like this. So this is your total issue cost. But what I'm now saying is, you will now do a tax relief on this debt, on this issue cost of debt, on this 1,680. But you not do issue cost on 840. Tax relief is supposed to reduce this amount. So your tax relief now will be inflow. So you will now say, let's assume your tax rate is 20%. You will now say, you would say 1,680. You say 1 minus, say 0. Let's assume 20%. 1 minus 20%. But the problem or the challenge is, at some point or at some times, you discount normally. Let me explain. Normally, you this particular tax also, this particular what's the name? It should be charged at the year that the normal tax is being charged. What I'm saying is, if your tax is being paid in actual year, what it means is this issue cost also will be paid in actual year. This tax relief would also be in actual year. But if your tax is being paid in arrears, it means that this issue cost would also be paid in arrears. What I'm saying is, if your tax is being paid in arrears, this issue cost will be in year one because you're supposed to be in year zero now. It will not be paid in year one if it's in, but if it's in actual year, your tax is also supposed to be charged in that actual year. So you just do times 1.00 now. Since if your tax is in year zero times 1.00 year zero, so whatever you have here, you come and add it to it to relieve that tax. Do you understand? To relieve is a tax relief. So you come and do it to relieve this tax from here. So that is what I'm saying. Now that's for that. That's that. The challenge is usually with the what's the name? The challenge is usually with the sorry. It's not 1 minus 20. Sorry, it's times the tax rate. Sorry, not 1 minus. Sorry, it's times. Sorry, you just multiply it times the tax rate. Now, but the challenge is most times or sometimes or most times we always use year one for issue cost when you are doing the tax relief, regardless of wherever that particular, whether it's in arrears or is in actual year. Yes, I don't know if I'm making sense. For your issue cost tax savings, just use it at year one. Use it at year one, regardless of whether your tax is being paid in arrears or being paid in actual year. But the thing is, still follow the question. So the thing, when we read questions, I'll be pointing out these things to you. I'll be pointing them out to you. The questions determine a lot. The questions determine what you will do. If the question does not say that issue cost, they get tax relief on issue cost, don't charge tax on issue cost too. Is the question. If the question says and they are eligible for tax relief, the issue cost is eligible for tax relief, we will do it like this. But if the question is silent about tax relief on issue cost, just leave it. Do you understand what I'm saying? If the question says do tax relief on issue cost, fine, come and do it like this. But if the question does not say tax relief on issue cost, please ignore and just do 4% or whatever the percentage it on either the gross finance required or the finance or the gross finance raised, anyone. So that is an issue cost is always an outflow. Now, the next one, this is for issue cost. The next one is, say, PV of, say, interest. You say PV of interest. This PV of interest now, what we are saying with this PV of interest is we are basically saying that at the end of the day, you have gone to borrow the money that we say you should not borrow now. So you've borrowed the money. So we will now do the present value of the interest that you are paying on that money. Don't forget what we are trying to do. We are trying to do an effect of all the money that you've eventually gone to borrow. That's what we are doing. We are trying to do an effect of all the money that you've eventually gone to borrow. So you would now do all the financing effect. That's what I'm saying. Now, how do you do PV of interest? This PV of interest is actually very simple. So what you just do is, let's say the amount is 242,000. Let's say you pay. The question will say, let's say you are paying maybe 8%. 8% as interest. So what I'm saying is, what is 8% of 42,000, please? So you now say, what 8% of 42,000? You say 8% times 42,000. That's the interest, Abby. How much is it?
3,360.
3,360. So once you've gotten the interest that you are paying, just do it times the tax rate, the current tax rate of say 0.20 times the discount factor. But the thing is, this discount factor, don't forget that it's annuity factor now. Since you are paying, what am I saying? Since you are paying, if you are discounting it, how would I explain this thing now? Now, let's assume it's for 4 years or for 5 years. What I'm saying is you will get the discount factor for that 4 years. But the problem or the challenge is you are paying a constant interest now. So you use annuity of that 4 years or 5 years. You are paying a constant interest of 3,360 every year. So you just do annuity. It's times discount factor. This is the formula. Let me write the formula for you. So you see interest, let me write it. Interest times your current tax rate times your discount factor at annuity at, please, when you are discounting these ones, either your interest or your subsidy, please always discount at your, either you use your cost of debt, at your cost of debt or your risk free. Do you understand what I'm saying? When you are discounting this interest, your issue, any PV of financing effect that you are discounting, either issue cost, either interest, either subsidy. Don't go and be discounting at cost of equity. It's a debt now. The PV of the financing effect, they are debt now. You have gone to finance the business with debt. So we're just trying to check the effect. So either you discount with your cost of debt. If it's 7%, 7.5, discount with your cost of debt, or your risk-free. Anyone, just discount it with it. So what I'm saying is, this is your annuity now. Let's assume your cost of debt is 7%. This annuity that you will look for, it will be at 7% and that cost of debt, or at the risk-free. I don't know if I'm making sense. Please, do we understand what I'm saying? So if you want to do this, you can we can leave it at steps. So if you want to use it as step, we can say step one. Let's say step one, let's accumulate all interest. We accumulate all interest. We say step two, so that's easy. We say calculate. Say calculate. This is one I used for them last day, Say calculate net interest. How do you calculate net interest? You're just simply going to do the interest multiplied by the tax rate. Multiplied by the tax rate. Then your step three now. Your step three. You say step three. So step three, you say calculate PV of interest. PV of interest. Your PV of interest, which is now your net interest. That is after you've done your interest times tax rate. Is your net interest times your discount factor. Now, for people that like formula, thank you, madam. I've seen it. 7513. Thank you. For people that likes formula, you will use this one. For people that likes to cram story, you can use this one. Anyone is work. First, calculate all interest. Obviously, we are paying interest on the stuff now. So calculate all interest first, then the net interest, that is all the total interest times the tax rate. Now, the problem is, the question that will be on some of you mind is, why am I accumulating all interest? Why do I have all interest? It's not one particular debt. Why do I have all interest? Now, the thing is, when it comes to APV, there's always a story in the question where the question says, the government likes you, they like your investment. Not only for APV, they happen. They happen for real life. They will say, the government likes you, they like your investment, they like your business. They want to subsidize, they want to collect a particular. What I'm saying, don't forget, what we want to do is 100 million, Abi. They want to say a government like it, they decide that they will pay you, that they will give you 40 million out of the 100 million that you want to go and do at a subsidized rate. So let's say that you want to go and borrow that particular, you wanted to go and borrow that particular money at 10%. So what we are saying is, they will not say government will give you at say 5%. But you'll be paying that 5%, you'll be paying 5% interest instead of the 10% interest that you'll be paying. But don't forget that it's just 40 million that you are borrowing from them. So what we are saying is the total interest that you are going to be paying. So you are paying 4% on how much? 40 million. Sorry, 5% on 40 million and 10% on what? 60 million. Do you guys understand what I'm saying? Yeah, do you guys understand? I need to confirm.
No, sir.
No, sir.
What I'm explaining is, when I'm talking about net interest or all interest, it's simple, it's grammar. They will say it in the question that the government likes your investment. And you want to go and do the investment for 100 million before Abi. They will now say government likes it. The government will now say, okay, instead of you going to borrow 100 million, we'll give you 40 million out of it at a lower rate. You wanted to go and borrow 100 million at 10% before. Government now said that, okay, instead of you go and borrow 100 million at 10%, let us give you 40 million out of it. But we'll not give you at say 5%. So what you have borrowed from government is 40 million at 5%. and what you've borrowed from the bank now is you could not borrow 100 million again. And since somebody's already giving you 40 million, you're now going to borrow 60 million at that same 10%. And so they have subsidized it for you and they've reduced it for you. So what you will now calculate, so all interest that I'm talking about here is 5% of 40 million that you are collecting from government, you are still paying that particular interest. What's 5% of 40 million? How much is it? Sharp. What's 5% of 40 million?
2 million.
Yeah?
2 million.
2 million.
So 2 million is the interest that you're calculating on government, 2 million. So what is now 5%? So what's now 10% on 60 million? That should be 6 million now.
Yeah, 6 million.
6 million.
Yeah, so your total interest, so your total interest now is 8 million like that. So that's total interest that you're paying out. That's just what I'm saying now. So that 8 million is what you now bring here. So accumulate all interest is what I'm saying. So calculate the interest from your bank, interest from government together, add it together. Once you have that one, net interest, that is those total interest times tax rate, that's 80 million, 8 million times, let's assume our tax rate is 0.20. So you have your net interest. You now come and do PV of interest. That net interest times your discount factor, you discount at your cost of debt, annuity of it. Whatever you have is your PV of interest. Is it clear now?
Yes.
Yes, sir. To some extent.
It's not to some extent, though. It's issue cost that should still be a challenge. These ones are simple. Issue cost is always tricky, but these other ones are simple. It's not a problem. The total interest, calculate it together, net interest, charge tax rate on the total interest, then come and do PV. It's not how I do. People should not be saying to a good extent. If I was explaining this to skill students now, it's understandable, but you are big boys. So the last one.
Hello, sir.
The last one is your subsidy. Last one, please hold on questions, please. The last one is your PV of subsidy. That's the last one. Now, for your PV of subsidy, don't forget what I explained earlier, where I told you that they said that government would like your investments, blah, blah, blah. Then they will say government is giving you at 5%, Abi, but you are going to borrow it outside at 10%. Now, what I'm now saying is, if you now want to do this, but don't forget the challenge. The thing is, the subsidized loan that government has given to you, gone. What I'm saying is, the total amount is not how would I explain it now? It's not the total amount that you've gone to borrow. Government have subsidized a particular amount for you in this particular question. So with this one I gave you as example now, the total amount was supposed to be 100 million, Abi, but government has now given you 40 million out of it. So there is already a subsidy of 40 million, Abi. You are not going to bank to collect other 100 million. So you now say subsidized loan. Let me first write formula for people that like formula. You now say subsidized loan. If you say subsidized loan, obviously you charge it post-tax. You say 1 minus T. 1 minus T. You will now come here. So you say times. Don't forget that there was a rate. Your normal borrowing rate times your normal borrowing rate. Your normal borrowing rate minus your subsidy rate. Your subsidy rate times your discount factor. Still the same discount factor that you used here, still same annuity. So for this example I give, what I'm saying is you now do 40 million. Now do 40 million. 40 million, 1 minus 0.20 times what's our normal borrowing rate? 10% minus our subsidy rate is 5% times, I don't know the discount factor, whatever discount factor that it is, you put it there. It's no more than this. It's no more than this. So now for people that like story, say step 1, calculate the savings on subsidy. That is how much you are saving on that subsidy. That's the amount that government is subsidizing for you now. So after that one, you now calculate. So after you calculate that, you now calculate. Okay, no, don't let me say it like this. Don't let me say it like this. Let me say calculate. Let me say calculate amount attributable to subsidy. You can calculate this one. After this one, you now say calculate your savings on subsidy. Don't forget that the fact that you are don't forget something that the fact that you are saving on total amount, you are also saving on the rate. Yes, now you are saving. Government is already subsidizing 40% for you, Abi, but you are saving on instead of you to go and collect 100 million at 10%. You are now collecting 60 million at 10%, then 40 at 5%. So there's also a savings on subsidy on the rate as well. So from here, you will now say normal borrowing rate minus subsidy rate. So after you've gotten this one, you will now calculate. So you now say calculate net subsidy. So your net subsidy now is now going to be equal to your subsidy amount times your savings on subsidy. That is whatever rate that you have here now. Your savings on subsidy. Let me do this. The subsidy amount is going to be is post-tax 1 minus T times that particular savings on subsidy. So the last step now is now going to be calculation. You now say calculate. You say calculate PV of subsidy, which is equals to your net subsidy times your discount factor. All this grammar is just this formula that is written here. All this grammar is just all this story that is written here. Now, let me explain. Let me just recap everything. So what I'm saying is, interest, just use that interest rate, the total particular interest that has been subsidized. The story will tell you is going to be in the story of the question. The government like the project, they want to subsidize you with 20% without depending on the rate. Just take that rate, go and calculate the interest on that particular one. Calculate the total interest from bank also as well. Add it together. Whatever you have, charge tax on it. That amount that you now have later, go and discount it. Your discount factor, discount it with your cost of debt. That is for that. Then for subsidy, there's already a particular amount that government is subsidizing for you now, say 40 million. And that 40 million, do it post-tax, then multiply by the rate, that is 10% minus 5%. So 5% times your discount factor, you get your PV of subsidy. And your PV of subsidy is always an inflow. So this is what I'm saying. So I'm now saying this is now what you will now later have at the end of the day. So you will now do it like this. Your issue cost is an outflow. It's always an outflow. You bring it down. Your interest is an inflow. Your PV of interest is an inflow. So you now do it like this. Then lastly, you will now do your subsidy as well. So whatever you have from this calculation, you will now go and bring it to your PV of what? Your PV of financing effect. You're going to bring it to it could be positive, it could be negative, anyone. But most times it's always negative anyways. Most times it's always negative. But it could be positive, it could be negative. So whatever you have is your adjusted present value. Please, real quick, please, do you have any question, please? Ask me. Please raise up your hand and ask me your questions now, please. Yeah. Ugo Chuku, please, your question.
All right, sir. Good evening, sir. Good evening, everyone. My question is regarding issue costs. I wanted to ask, would they always give us issue costs as a percentage, or would there be a scenario to give us issue cost like the normal cost? For instance, now.
Always a percentage.
But I saw a question. Sorry, sir. Yeah, I saw a question that they gave us issue cost like equity 20,000 and debt 100,000. How do I handle something like that, sir?
If it's given to you, if it's given to you like that, it's even better. Yes, now if it's given to you in figure, it's even very, very better. Because why we are charging the percentage is actually to get the amount of issue cost, since it's in percentage now. So if you're given to you in amount, go and use the amount like that now as your issue cost. But the only problem is, it now depends on the question. If the question now says issue cost is on gross finance risk on gross finance acquired, if it's on gross finance, but if the question has now, listen to me, if they say the issue cost is on gross finance acquired or on gross finance risk, but if the figure has been given to you, What they are simply saying with the figure is they've calculated that issue cost for you. Listen, they've gotten it for you. So what you will just go and do is just go and take that amount and go and use it like that. But the only thing is, if it's now separate, if it's on equity, fine. But if it's on debt and they say it has tax relief, it means that you're not going to do tax relief on that issue cost of that debt. So that tax relief, it will not be, those issue costs will be in negative, it will be in bracket. Then that tax relief will not be in positive. So that you just use that positive to less those values, then you will not get your new value of issue cost. If it's in amount, it's better. They've done all the work for you.
All right, sir. Thank you, sir.
But do you understand what I'm saying?
Yes, I understand you totally.
Thank you. The whole percentage story, the whole gross finance required, gross finance raise is because of that percentage. Because we are charging 4%, 5% or something just to get the issue cost. But they tell us issue cost is 20% or 20,000. Issue cost is 10,000. And they've done the percentage for us now. So we don't need to go through that route again. Thank you. Ms. Chika.
Good evening, all. Good evening, Mr. Olashinle. Please,
Good
you
evening.
said we can either use cost of debt or risk-free. Even while it's giving us two different answers, is this still correct if you use either of them?
You would not know if it's giving you two different answers now. In the question, if you are giving risk-free, listen, in the question, if you are giving risk-free and cost of debt, use only cost of debt. Don't use, you can never use it. So don't use risk-free. But in situation where you are not giving cost of debt is what I'm saying that you can use risk-free. If you were not giving cost of debt, you use risk-free. But you would not know it's giving different answers. Since it's only one you eventually have to use. I don't know if I'm making sense. It's not a compare or contrast something. It's not as if you are comparing this to this. So since it's only, you can use either. In the question, if you are giving cost of, if you are giving the two, obviously it is very, very possible. It's even the most likely thing. If you are giving the two, go and discount with your cost of debt. But in scenario where you are not giving cost of debt, go and discount with your risk-free. It's not more than that. So it's not a this or this. It's not a this
All
and
right.
this something.
All right. Thank you, sir.
You're welcome. Amaka, your question, please.
Okay, sir. I didn't get your answer when you were explaining the point where you said if we are not giving risk-free rates, market premium in the question, after we must have ungeared and gotten our asset beta. You said we're going to use M&M formula. So what do we do with asset beta?
What do you do with?
The asset beta after ungearing.
No, the thing is, in such scenario of question, you would not need asset beta for anything again. I'm just saying scenario where you were not giving equity beta to ungear at all.
No,
in a situation where you, that's what I'm saying now. In a situation where you were not giving beta.
Yes.
If you're not giving beta, obviously you are not giving equity beta too now. So you're not giving any beta to either ungear or do anything with. Just go and use your M&M formula. You are not giving beta at all. So it means that you're not even ungearing in the first instance. So you don't even have BA in the first instance at all. You don't have any ungearing. You don't have any ungearing to do. You go and, so in question, you read the question. There's nothing like equity beta, asset beta, nothing. They were just giving you. They just gave you cost of equity. They gave you cost of debt. But the cost of equity they gave you, they say maybe it's cost of equity geared or cost of equity of a geared company. So in that particular scenario, you will now go and use M&M to get your cost of equity ungeared.
Okay, sir. Thank you.
Do you understand?
Very well, sir.
Isiak, your question, please.
Good evening, sir.
Good evening.
Thank you very much, sir. My question is that in the question, are they going to give us a discount factor before we can use annuity method?
That's what I just explained now. You are not following me. The discount factor is your cost of debt. They will give you cost of debt, obviously now, but discount factor is your cost of debt or your risk free. And it will be given to you in the question. So just take the cost of debt that is being provided for you in the question, go and discount it with it. And if it's risk free, go and discount it with it. No pass like that. Do you understand? Yeah, Victor, your question, please. I need to solve a question at least before I go.
Yes, sir. You said the interest is an outflow, is an inflow. I was thinking it ought to be an outflow because when you're paying
tax savings,
an interest,
it's tax savings. It's not just
Okay.
interest that you're paying. It's tax savings on interest. That's the full name.
Okay, all right. I get it right.
You get it now. It's not just interest. It's tax savings on
Okay, I
PV of
was thinking.
savings on
Okay, I was
interest.
thinking you said interest. I would have said that interest is an outflow.
Sorry. I wrote interest actually, but it's PV of tax savings on interest. It's tax savings, so it's an inflow. It's PV of there's also tax. It's subsidy. It subsidizes an amount for you, so it's also an inflow. For issue cost, you are paying it out, so it's an outflow. Do you understand it now, Miss Mary? Your question, please.
Sorry, based on the PV of subsidy we just did.
I can't hear you. You are breaking now.
Sorry, can you hear me now?
It's a little better.
PV of subsidy we just did.
You are still breaking. I cannot hear you.
Tax from this.
You are breaking.
I'll ask you later.
Okay. Please, do you have any other question, please? The thing is, at the end of the day, while looking at it from the top of your head, it might be a little bit too much. But when you start putting figures to them, it makes a whole lot of sense. It makes a whole lot of sense. It's not hard. Do you understand? It's not particularly hard. Just try to understand what we are trying to do. You do your normal base case MPV the normal way we used to do. When you get to discount with your cost of equity. And when we get to your PV of financing effect, issue cost, read the question. Is issue cost on gross finance required or is it on gross finance raised? If it's on gross finance required, just go and take your working capital and your initial outlay, add it together, then do your issue cost, just do issue cost, multiply your issue cost rate times, they'll give you your issue cost, you multiply times, it have your issue cost. But if they say your issue cost is tax relief, bam, under it, do that particular issue cost, multiply by the current tax rate, then annuity factor at year one. You are still discounting with your cost of debt there. Do you understand? You're still discounting with your cost of debt there. Your cost of debt or your risk free at year one. So just get that year one. It's tax savings now. So it's going to reduce that tax. So it's not going to be positive. So you add that to your what's the name? You add that one to your issue cost that's already in your negative. Then you have your total issue cost. Bam. Then from there you move to your PV of finance. You move to your PV of interest. Just calculate your total interest first. That is the interest on the government subsidized loan and the government on the and the interest on the normal loan. Add it together. Bam. What the total interest that you have. Charge your current tax rate on it. Charge your current tax rate on it. Multiply by the current tax rate. Then multiply by the discount factor. That's your PV of tax savings. Subsidy, obviously, the amount that government is subsidizing for you, say 40 million, for 50 million, the government is subsidizing for you. Do the difference between the rates. You are paying 10% for bank, you are paying 5% for government. That's 5%. And multiply by 5% by the subsidized rate. That subsidized rate will be post-tax. That is, you would have done subsidized rate 1 minus T first. Government is subsidizing 40 million. You have done 40 million 1 minus T. You multiply by the particular, the differences between the rate, then discount factor, either annuity, no pass like that. But let's put figures to it. So yeah, somebody read the first question for me, please. Oh yeah, sharp. I need to solve one question, please. Now, I'm thinking of something. I hope it works. If you can work, I will really appreciate. I'm supposed to drill you guys properly today. So what I want to do is I have an engagement for 7, but I should be done before 9. So I say 7 to 8 or 7 to 8:30. So we'll now have another class by 9. I hope I have the energy. If I do, I will really appreciate it. I will have another, but I have something to do. But let's just keep it like we'll have another class by 9. 9 to 11. So I'll start mergers and acquisition and business valuation by 9. If I have the strength to, that would have been the perfect day for me. I will know that I achieved this one and I achieved that one. So I will now start business valuation and mergers and acquisition by 9. I want to do something, but let's still see how we can at least introduction to it, at least, so that we can always pick it up from there. Oh yeah, Maliki, please. Oh yeah, your question chapter. Oh yeah, somebody should be looking for question 1. Maliki, oh yeah, talk to me.
Yeah, good evening, sir. Thank you very much, sir. So my question is, I've seen some questions that they are asking for that we use basis points. Please, can you explain more on that basis point and how to use it to discount the issue cost?
I've explained basis point like 3 million times in this class, like 3 million times in this particular class.
I done it. I'm sorry, sir.
When we get there, I think the question here is talking about basis point. I'll explain it together then.
Okay, sir. Okay.
Yeah, please, somebody with question one, please. Fast. I need to leave this class by 7. Yeah. I'll stop sharing my screen for a while. I need to do something. Somebody with that first question APV for me now in the question bank.
Yeah, I recently commenced working for Equatorial PLC and are reviewing a 4-year project which the company is considering for investment. The project is in a business activity which is very different from Equatorial current line of business. The following net present value estimate has been made for the project. So we have that table. Net present value is negative 1.65 million, and therefore the recommendation is that the project should not be accepted. In calculating the net present value of the project, the following notes were made. 1. Since the real cost of capital is used to discount cash flows, neither the sales revenue nor the direct project costs have been inflated. It is estimated that the inflation rate applicable to sales revenue is 8% per year and to the direct project costs is 4% per year. 2. The project will require an initial investment of 38 million naira. Of this, 16 million naira relates to plant and machinery, which is expected to be sold for 4 million naira when the project ceases, after taking any taxation and inflation impact into account. 3. Tax allowable depreciation is available on the plant and machinery at 50% in the first year, followed by 25% per year, thereafter on a reducing balance basis. A balancing adjustment is available in the year the plant and machinery is sold. Equatorial pays 20% tax on its annual taxable profits. No taxable allowable depreciation is available on the remaining investment assets, and they will have a nil value at the end of the project. 4. Equatorial uses either a nominal cost of capital of 11% or a real cost of capital of 7% to discount all projects, given that the rate of inflation has been stable at 4% for a number of years. 5. Interest is based on Equatorial's normal borrowing rate of 150 basis points over the 10-year government yield rate. 6. At the beginning of each year, Equatorial will need to provide working capital 20% of the anticipated sales revenue for the year. Any remaining working capital will be released at the end of the project. 7. Working capital and depreciation have not been taken into account in the net present value calculation above, since depreciation is not a cash flow and all the working capital is returned at the end of the project. It is anticipated that the project will be financed entirely by debt, 60% of which will be obtained from a subsidized loan scheme run by the government, which lends money a rate of 100 basis points below the 10-year government debt yield rate of 2.5%. Issue costs relating to raising the finances are 2% of the gross finance required. The remaining 40% will be funded from Equatorial's normal borrowing sources. It can be assumed that the debt capacity available to Equatoria is equal to the actual amount of debt finance raised for the project. Equatoria has identified a company, Ethiopia, which operates in the same line of business as that of the project it is considering. Ethiopia is financed by 40 million shares trading 3.2 naira each and 34 million debts trading at 94 naira per 100 naira. Ethiopia's equity beta is estimated at 1.5. The current yield on government treasury bills is 2%, and it is estimated that the market risk premium is 8%. Ethiopia pays tax at an annual rate of 20%. Both Equatoria and Ethiopia pay tax in the same year as when profits are earned. You are required: A. Calculate the adjusted present value for the project, correcting any errors made in the net present value estimates above, and conclude whether the project should be accepted or not. Show all relevant calculations. Should I stop here? Hello?
You've read the question and the 2 questions. Have you read it?
Yeah, the should I continue with the B? Okay. Comment on the
Yeah,
corrections. comment on the corrections made to the original net present value estimate, and explain the APV approach taken in Part A, including any assumptions made. That's all, sir.
Thank you very much. Assignment. Assignment. Oh, yeah. Number 1.
Okay.
Assignment number 1.
We have to get the policy company.
Well, it can be get the proxy company for assignment. I saw, madam. I say assignment. You say get the proxy company. Bitibao. Assignment number 1. State 5 advantages and disadvantages of APV. State 5 advantages and disadvantages of APV. Number 1. Number 2. What are the assumptions of adjusted present value? State the assumptions of adjusted present value. Yeah, let's solve this one. So I'm assuming you guys can see my screen now, right? So, yeah.
Yes, sir.
I will not delete all these explanations. What's today's date, please? 9th of September.
Today is 5th.
5th.
So number. Sorry, I don't the jump. 5th of number 2. I said state the assumptions of adjusted present value. 5th of September. Say adjusted present value. So many people that calls figure for me. Who was that beautiful person that finished reading this question from me? Sarah, please, your mic is not muted. Who was that person the beautiful person that read this question for me now?
Fatia, sir.
Miss Fatia Jala, please, you would call figure for me. Miss Amaka, are you there?
I am, but I don't have the question. I don't have the question.
You don't have the question. I don't think you are ready for this class. It's the same one with that thing now, with that normal material that we've been using. It's just in the question bank. Who will now call question for me like this? Inform Robert. I had a crush in my secondary school that was inform. Inform Robert. I don't know if you have calculator. If you don't,
Sorry, sir, I don't have a calculator with me yet. I'm on route, so I'm sorry, sir.
How do you not want to call figure for me? How do you? Hey, now wow. People shall want the men to undo this class today with the way people are doing like this.
Apologies, sir.
Oh yeah. Let's do men today. Let's do men. Let's see how it will go. Even though I know I will regret my action, but let's go. I will not do a dick. Oh yeah, Peter Amos. You have calculator there. You see. Oh yeah, if any person that have calculator,
Yes,
you have
yes,
calculator. Oh, this thing no go. You no go. Yeah, Olusegun, you call figure for me. Peter Amos, you call figure for me. I need one more person.
I will call.
No, we are doing men, strictly men. No, Chombi, you call. When I was looking for women, no deal. Strictly men today. Today is men's word. We have one more person, sharp. I need one person to volunteer, please. Just one more man. Maliki, you have calculator. Mr. David.
Yeah.
Okay.
Yeah, I want to I have calculator here.
So Mr. David, Olusegun, and who's the last person? Peter Amos. So the three of you are calling figures for me. Please, you push. Shame these women that this will be slow. You should be active, please. And please keep your mic muted and just be at alert. Oh, yeah, let's go. So the first thing we'll do is we'll know that so we'll say calculation, or so we'll say question one. We'll say question one. What calculation of APV. So you now come here and say, so you would now do this in a small. Let me increase this a little. So you now come here and say APV equals to, you now do something like this. And do something like this. You would say base case. You say base case NPV plus, you come here and say your PV of financing, your PV of financing, PV of financing effect.
You're not seeing your board.
So let's go and start one by one. So the first one we'll do is let's go and do our base case MPV now. So that's the first thing. So that's the first thing you do. So let's go and start our base case MPV. What's the challenge now? Why am I hearing some side comments? What's the problem? Is there any challenge?
Not seeing your board. Okay.
Okay. Oh yeah. So let's start now. Okay, I did say. Oh yeah. So let's go and do our base case MPV now. So you now come here and say base case. How many years?
4 years.
So hold on. Hold on. 4 years is the question. And our tax is paid in actual year now.
4 years, yeah. Yes, actual year.
Okay, so that means I have like about, since for a while without plus years, that means I have about 6 tables here. So you do something like this. So you do so I have about 6. Let me do 6 by 6. So I have here, sorry. I have here 0, year 1, 0, year 1, year 2, year 3, year 4. So what's the first thing I have? So let me come here and do workings. Sales, Abi. Abi now.
Yes, sir.
What's the challenge with the sales? What does happen to sales? What does happen to sales?
Inflation was not captured.
Inflation was not possible now. Now don't start.
It increases by 8%.
Now say inflation was not captured. People should not do this to me. I'm giving people a chance. You say inflation was not captured. Oh yeah. So what's the story behind it? Are we going from year 0? Are we going from year 1? What's the grammar? What's the initial one? What's the story? I'm gonna look.
From year 1.
Since the real cost of capital is to discount cash, neither the sales revenue nor the direct project cost has been inflated. It is estimated that the inflation rate applicable to sales revenue is 8% per year and to the direct project cost of 4% per year.
8% per year, yeah?
Yes, sir.
This is not the inflation rate, sales revenue per year, and okay. So it means that we are starting growth from year 1 now. So you would say something like this. So you say let's do sales first. Let me say 1. You say sales. So what's the first? What's the base year? What's the base year? What is the value of the sales that we are growing now?
23.3 million.
23.03.
0.03, sorry.
0.03.
1 point. Okay, let me do this. So you're saying 1.08 is power 1 plus 2. I hope somebody's
So
pressing
we
my
have
figures
figures
already.
for each year.
You have?
We have figures for each years.
Oh, it's not this one for. Okay. So what's for year 2?
36.6.
Year 3.
49.07.
We had people that I call that they should call figure. Oh god damn it. That's why I like to use women. Yeah, year 4.
27.14.
They are using glue or it is a lot. Before they talk like this, I've put the figure. Oh yeah, my answer, Joe.
Year 1, 24.87.
24.87.
Oh yeah.
42.69.
Year 4.
61.81.
36.92.
Yeah, 361.89.
Year 4.
It's one.
36.92.
Well, what's year 4? 36 point.
36.92.
Yeah,
It's only
361.81. Yeah.
Yeah. So let's do our next one. The next one is direct project cost, Abi.
Yes, sir. At 4% per year.
So direct project. Yeah, what are the
Negative 13.8.
Negative
figures?
3.
Negative
What are the figures?
13.8.
Year 1,
Like the base year
13.82.
figures.
13.82.
They didn't give us.
Yes, they give us direct project costs.
Negative can
13.82.
Call figure for me now.
Oh, year 1.
Negative 13.82. Negative 21.93.
21.96.
Don't call negative
21.96.
for me. You guys know why. You guys know why the negative is there. They're
Year
obviously
3.
just acting. It's nothing like
29.44. 29.44. Year 4, 16.23. 23.
How do I have? D23 will be 28.
23.
Okay, yeah.
Year 4, 18.99.
18.3.
99.
Cannot be 1.8. Cannot be 1.8. Now we are multiplying 16.23 by something.
It's correct.
1.8. Okay, it can be.
Correct.
Correct.
18.99.
18.99.
Year
Year
1
1 what?
14.37.
Year 3, 33.12.
Year 2 3.75.
This is the first man's voice I'm hearing since we began this class today. No one. So let's go and put all these figures there. I hope somebody has the pictures already, or somebody has the figures already. Yeah, what was my year 1 24.87. Year 2
42.69.
61.81.
36.92.
92.
Yeah.
14.37. 23.75.
923. Okay, 23.75.
33.12.
33.12.
Oh, yeah.
18.98.
18.98.
99.
It's 99 if you
Yeah,
approximate.
please calculate my profit for me like that.
Year 1, 10.5.
Start writing it down. I'm 10.5. I'm with you. Continue. Year 2.
Year 2, 18.94.
Year
Year
4,
3, 28.69.
17.93.
Year 3,
Year 3, 28.69.
28.69.
28.69.
69.
So what's the next thing? Tax, Abi? What's the tax rate?
20%.
20.
20%.
20%.
20.
I'm sure it's the same. You should read where that tax rate is for me.
Additional information 3.
Tax allowable depreciation is available on the plant and machinery at 50% in the first year, followed by 25% per year. Therefore, thereafter, on a reducing balance. A
That's
balancing
tax
adjustment.
allowable. I'm talking about tax rate.
Yes.
Tax rate.
Sorry.
Equatorial pays 20% tax on its annual taxable profit. No tax allowable depreciation is available on the remaining investment assets, and we have a all value at the end of the projects.
Yeah. So 20%. What do I have?
2.1.
2.1.
3.8. Second year. 3.8. 5.3.
7.4.
3.6.
5.7. 5.74.
Yeah, since we've been using one decimal, let's just stick to it, please. Yeah. From there, what do we want to do? So tax savings from capital allowance now. So you not do tax savings.
So the third one should be 5.8.
5.8. Is it 5.8 or 5.74? Please confirm.
It is 5.7 now.
5.74. 5.7.
5.74. 7. Okay, yes.
Still same as 5.7.
One decimal place.
So you said tax saved. On capital. So I'm also going to copy a bit. I'm going to copy one a bit. Get stand for. I hope you guys have my figures already. Yeah. So it's 4 years now. Don't worry, I would adjust it. Okay, let me just delete these ones. Let me leave this. So yeah. So what's my cost?
16 million.
16 million.
16 million.
What's the grammar about my capital allowance? About my annual allowance?
50% on
For
the
the
year
first
one,
year is 50%. Then the
then
consecutive years is
25% on
25%
the
on the
reducing
balance.
balance.
Okay, 50%, 25% here too, Abi.
Yeah.
Get three go.
The same.
25%.
Okay. Yeah, what's 50% of this 18 million? What do I have?
8 million.
8,000.
What do I have? So what's my tax in down value? Sorry, let me just change this to
8,000.
Okay, let me just see. No, we are raising to the power of million now, so everything should be in million. You understand? We are raising to the power of million. Everything should be in million.
8.
Okay. 8.
NM.
So what's my tax in down value? 8 now.
8.
Yes.
So 25% of 8 is what?
2
million.
2.
2.
So my tax in down value is 6. So 25% of 6 is what?
1.5.
1.5.
My tax in down value is what?
4.5. 4.5.
4.5.
So the last year now, obviously, what's my sales proceeds?
4 million.
4.5.
4 million. That's 4 now.
Yes.
So what do I have as my is it balancing allowance or balancing charge?
Allowance.
Balance.
So that's 0.5 now.
Yes.
So how many percent are we charging on it? This is 25%.
20.
Yes.
20. Yes.
Yeah, 20%. 20% of this.
1.
0.1.
First year.
0.1.
Sorry, Abi?
First year 1.6.
Sorry. I don't make mistakes. Sorry. This should be like this. Sorry. Oh yeah, let's start from here. So our tax savings on capital allowances are 20%. Our tax rate. Oh yeah, 20% of 8.
1.6.
1.6.
What do I have here? 1.6. What do I have here?
4. 3.
0.4.
0.4. What do I have here?
0.3. This one. 0.3.
0.3.
So this one is 0.1, Abi?
Yeah.
Yeah, bring my figures yet for me. So 1.6, 0.4, 0.3, 0.1. So do we have so let's do initial outlay. So what are initial outlay?
38 million.
38.
What's our crap?
4.
4.
So what's the grammar? Do we have working capital? Do we have working capital?
Yes.
Yes.
Yeah.
What's the grammar?
Capital.
At the beginning of each year, Equatorial will need to provide working capital 20% of the anticipated sales revenue for the year. Any remaining working capital will be released at the end of the project.
Okay. So yeah, let's go. So let's first start from here. So that is basically, see, this one that you've done alone. That's why I said, that's why I explained to you earlier in the first class that you need to understand it. This one that you've done alone is plenty mark. You understand? It's mark. So you need to just understand everything that we're doing at the end of the day. Working capital. Somebody's unmuted. I'm still going.
Mr. Olusegun, please can you mute yourself?
So 4, 5, 7, 4. So you see here. So David, please, you are disturbing my class, please.
Oh, sorry, sir.
So you see here 0, 1, 2, 3. 0, 1, 2, 3. Don't go do rubbish. 1, 2, 3, 4. So yeah. So our sales revenue now. So let's start with sales. What's the value of our sales? Year 1.
24.87.
Year 2.
42.69.
42.69.
Year 3.
61.81.
61.81. Year 4.
36.92.
36.92. What they say about the working capital? They said is what?
20%.
How many percent?
20%.
20.
Yeah. What's 20% of this?
4.97.
4.97.
8.54.
The last one,
12.36.
7.38. 7.38.
So you now don't forget now differences. So you now say changes in working capital. Yeah. So this one now still be 4.97. What do I have next?
No, that one will be year 0.
I know now I've not done relevant here now.
Negative 3.57.
3.57 negative.
Hold on, no. Negative as in. Okay, negative 3.57.
Minus.
Okay, 3.557. I get.
Next one, 3.82. Yeah,
3.82.
3.82. Positive.
Is it positive or negative?
Positive.
It's positive. Even the second one is positive.
Exactly.
The second one is positive as in.
42 minus 8.
This is the one we are looking at now. This minus this.
Of course, now that's 3.57.
Be negative, okay.
3.57 is positive.
It's positive. It is
Hey,
better
but working
than
capital is outflow now.
Oh, yeah. Sorry.
Working capital is an outflow normally. Why are people doing like novices like this?
4.98.
Okay, I need one more year, sir.
4.98.
4.98.
4.98.
8.
Is this one now positive or negative?
Positive.
Positive.
Do you understand why it's positive?
Okay.
7.98 minus 12.36 will give you a negative normally. Negative times negative will give you positive. Your working capital normally should always be in positive. It's an outflow. And I've explained why like 3 million times. It's an outflow. Working capital is an outflow. So whenever you know that it's working capital is an outflow, but this one is supposed to be an outflow normally, but because this 7.38 is less than 12.3, it would have given you negative. It should now be negative multiplied by negative. It gives you positive. What do I have for the total?
7.38. 7.38.
So you now come and do relevant here. This is the way I like to do it. It's clearer to me this way. You can, from here, from these changes, you can bring your own to year 0 from there. That's the one that works for you. That's why I said that you guys need to solve questions so that you know the one that works for you. This is the method that works for me. Anyone is allowed. So I'll now come here. I'll bring my figures here. So I'll say year 0, 4.97. I know that my negative 3.57 is coming to year 1. Negative 3.83 is coming to year 2. 4.98 is coming to year 3. And my year 5, 7.38. Yeah.
Negative, sir. The last 7.3.
Negative, Abi?
Yes, sir.
Well done. A round of applause for yourself. Give me my working capital figure, child. Why do you want it to be negative? Why do you want it to be negative?
4.97.
4.97.
Year 0. Year 1, 3.57. 3.57. Year 2, 3.82. 3.82. Year 3, 4.98. Positive. And last one, 7.38. Positive.
Working capital, everything will be recouped at the end of the year. How many times should I say it? And it's going to be positive. Everything will be recouped at the end of the year. Everything will be recouped, and it's going to be an inflow. Everything, no matter the stuff, it will be an inflow at the end of the year, and it's everything that will be recouped at the end. Good thing you now want again, make I explain like this. Go. Oh yeah. So what do I have as my? Oh yeah. So what's my net? So what's my net cash flow?
Last year, 29.01.
Hold on. Oh. One class. No problem. All right. So what do I have here? What do I have?
The last year, 29.01.
49.
42.97. The 0 year. Year 0.
42.97. We are somebody to pick one year and let me know.
The last year, 29.01.
29.
The third year, yes.
29.
6.43, year 1.
Year 3, 28.23. Year 2, 11.73.
Don't tire. See, is this me that wants to do another class? Actually, yeah, let's go and calculate our discount factor. So, so let's go. So you now say working skill management and working strive. You say calculation of cost of equity on geared. So what did they give us? They give us proxy. They give us proxy company information. Now, what did they tell us about proxy company? What's their beta? Is it equity beta or asset beta?
Equity beta.
Say proxy company. Proxy company. Equity beta is equals to 1.5. Oh yeah. So what do we do now?
We on gear to get asset beta.
So you on gear. So you now say on gear the equity beta. So you now say BA equals to, people know the formula, people don't know it. Let me try to write it for the people that are joining. If it's just left for you people, I will not write it down. Because I've written this formula in this class. Don't like 3 million times. You see equity. Do we have debt beta in the question?
No.
Okay. Oh, yeah. Close this back. So what's my beta equity of gate company? 1.5. What's my value? What's the value of my equity? What do you say about the value of equity? Did they give it to us? Is it?
They said it's 40 million, and then it's sold. The share price is 3.2. So that's a total of 128 million.
Well, let me write it here.
128.
Let me say calculation of market value. So we are saying number of shares is what? 40 million.
40 million.
What's the market price?
3.2.
320.
So what do I have?
That's 128.
128.
So let's do for debt once and for all like that now, since we're already there.
The debt is that's 1.9. Okay.
50. So if I come here and say debt, say debt value. Yeah, what do I have for my debt value?
94 over 100.
100.
Times 34.
What's it called? Times okay, 34. So you say 34, sorry, 34 million. 34 million times 94 over 100, have we?
Yes.
Yes.
Not sharp. 94 over 100. What do I have?
31.96 million.
31.96.
No, that's what?
31.96.
31.9. That's 32 now.
Yep.
Yes, approximately.
No, 128. 128 over 128 plus 32.
32.
1 minus. What's our tax is 0.20, yeah?
0.2. Yeah.
How do I have?
That's 1.25. And
So that's my BE now. So you're not going to do your CAPEM.
Yes.
You know it, You're not going to calculate. So you now say calculate cost of equity using CAPEM. So you now say the cost of equity on debt is equals to your risk-free plus your asset beta now, your RM minus RF. Yeah.
So
what's our risk-free?
2%.
2%.
2%.
Plus 1.25.
1.25.
What's
Times
our
8.
market?
That's premium.
8%.
8.
8%.
Yes.
What do I have?
12%. 12%.
These are our discount factors. So you're going to discount it 12. You're going to discount to 12%. I'm coming now. Yeah.
Year 1. 0.892.
0.892.
Sorry, 893.
0.797.
Mm-hmm. 0.712.
0.712.
0.71.
This
712.
0.712.
this 0.892 for year one.
Okay.
Yeah,
Oh, old age. How do I have for this one?
0.712.
This your
0.797.
No, for the last year.
0.636.
636.
636.
Oh yeah, so this. What's my what's my present value?
Year 4, 18.45.
18.
Yes.
Rent 45.
One 5.74.
Year one 5.74.
Year 2, okay.
Year 3.
Year 2,
9.35.
Mr. Shagun, please mute yourself now.
Next one.
Year
9.34.
20.10.
20.1. Year 3.
20.10. Year 3.
Year 2 is 9.34.
35 approximation.
9.35 year 4.
35, not 34. 35.
34 is not up to 5 now. That figure is not up to 5.
9.348. That is it. Yeah.
So what else? So what's my MPV? What's my base case MPV?
10.6.
Please, what's with the face now? What's with the
Mr. Olusegun, go off your camera.
Shagun, please, can you off your camera and mute
Okay,
yourself?
now why people disturbing my class? People are disturbing my class, please. Thank you very much. I don't need anybody to tell anybody to mute their mic. They're disturbing me upset. And Mr. Shagun, I think they warned you about 2-3 times. How about now, please? Help us. Okay. I think okay. Thank you very much. Okay. I think we'll have a peaceful class now. Yeah. So base case NPV
10.67.
10.6 negative, Abby?
Positive.
Is it negative or positive? Okay. So I'll bring this here.
Positive.
That's 10.67. Oh yeah, let's go and start. So let's go and start with our preview of financing effect. Let's go and do our preview of financing effect. So Mr. Shego, is this like, are you actually just joking with us? Like, I really want to know. Like, does this class just look like a joke? Like, I'm really interested. Is it until I block you from joining the call? No worry, I know what to do. Next time I see or hear anything, I'm totally blocking you and you are not joining this class anymore. You are disturbing us and we've been complaining since. You are turning on your microphone and you are turning on your video intentionally because you have to click something first. It's not as if it's doing it itself. You have to click it by yourself. So you've been clicking it intentionally just to disrupt us. Whenever it happens, I'm going to block you from joining this class and any other class. And that's the last one in this class and any other class. It doesn't look like you're interested. Anyways, so yeah, let's go and do our preview of financing effect. So you now come here and say PV of financing effect. Now the first one we'll do is issue cost. What's this? So you first say PV of, so you say PV of issue cost. So this is PV of issue cost. From here again you say PV of tax savings on interest. You now also say PV of subsidy. Let's start with PV of issue cost. You say PV of issue cost. So what's this like? So what's the grammar on issue cost?
Issued costs related to rising the finances are 2% of the gross finance required. The remaining 40% will be refunded from equatorial normal borrowing source. It can be assumed that the debt capacity available.
Okay. You don't
Sorry.
pass, but you don't pass issue cost now. You want to read the question again?
Apologies.
Issue cost is what? 2% of the gross finance required, Abi?
Yes,
Okay.
sir.
You now say that it can be assumed that the debt capacity available to Equatoria is equal to the actual amount of debt finance raised. It can be assumed that the debt capacity available to, see, that's why I told you, it's the question that will tell you what you should do. First of all, they've told you that 2% is of the gross finance required, which is fine. Now it's still the answer. It can be assumed that the debt capacity available, that is the total debt that is available for them, is the debt finance raised for this project. So what it means is the issue cost is inside. Do you understand? The issue cost is inside the gross finance raised. That is the grammar. They said it can be assumed that the debt capacity available to Equatoria is equal to the actual amount of debt finance raised for the project. So it means that the debt finance required, what's the debt finance required in this question?
40%.
That's how now. Debt finance required.
34 million.
34 million.
Where did you
Sorry,
see 34 from?
42.97. Sorry,
42.97. Now, he said
42.97.
is initial outlay plus working
Sorry.
capital.
Sorry.
Oh.
This is what I wrote here. Now. It's your initial outlay plus your working capital. That's your gross finance required, 42.97. That's what you got here. 42.97 is your gross finance required. Good. But the question now went and said that the total, see, the thing is, these questions can be confusing sometimes. So that's why I always tell you that your assumption sometimes can help you. You can decide to, I'm not saying you should do it, but what I'm saying is if you don't understand the grammar there, you can charge your issue cost. You can charge it on gross finance raised or charge it on gross finance required and move on. When you get to assumption, go and put it there. Do you understand? I was assumed that issue cost is on gross finance required, or so that issue cost is on gross finance raised. It depends. Is that you understand the question? That's why it's called attempt. It's not solve. It's not you that sets the question. It's attempt. Assumptions are allowed in SFM. You can assume and move on. Don't be stuck and leave it there. The person who are you leaving it for? Examiner. So don't assume and leave it there. Don't leave question. Go and assume and move on. So if the question is not clear, you can just assume that okay, 2% is on either gross finance required, or you can say you want to do your own on gross finance raised. But according to the question is saying that it can be assumed that the debt capacity available to Equatoria is equal to the actual amount of debt finance raised for the project. That is the line that changed the entire question. If that particular line of that question is not, if it's not there, the question, the total question could have changed. Do you understand what I'm saying? The total question could have changed, but because it is there, That is what we are now going to. That's what we are going to. So we are going to charge the 2% on the gross finance raised. This is it clear? Issue cost could be very, very confusing. And according to the question, I don't think I saw anything like tax. Did they say they have tax savings? Did they say they have anything like tax savings or anything?
No.
They don't have any tax savings, have you?
No.
So, but the thing is, let me explain again. The question determines what should we do. Please, the question determines what should we do. If the question says it is on gross finance required or it is on gross finance raised, just do it. But the thing is, normally, in a normal and in an efficient scenario, always charge your issue cost on the gross finance. I mentioned it from the very, very beginning. Always charge your issue cost on your gross finance raised. Always charge your issue cost on your gross finance raised, please. Always charge your issue cost on your gross finance raised. So yeah, so you now come here, you now say, so you now do so you now say issue cost, you now say issue cost. So if you want to get the gross finance raised, no, I told you in the question they will not give you. So you will now say, so you now say issue cost. You now say issue cost. Issue cost equals to you say net amount, or you can say finance required over what? 1 minus your issue cost rate. Yeah, what do I have? Sorry, don't let me do. Let me say finance raised. Let me say finance raised. That's what I'm trying to get. So what's my finance required in the question? What's finance required?
42.97.
42.97.
One minus 2%.
What's the issue cost rate now?
2%, sir.
0.02.
What's the cost rate in the question? 0.02. Yeah, what do I have?
43.85.
43.85. 0.85. 43.85. There's food in the kitchen.
43.85.
But they no bring you away. Can you do it? Well, get the lock smaller. 43.85.
Yeah, yes, sir.
I'm not finished it, done. But 43.85. Oh, yeah, Mungo. So what is so now you now do your issue cost. You now the issue cost equals to, so you charge 2% of this now. So you say issue cost rate times finance raised. So that would not be what now?
0.8.
0.877.
88.
So issue cost equals to, so you are saying 0.02 times 43.85. What do I have?
0.88.
0.87877.
Don't forget that what you just got is just issue cost. You will now say PV. You now say PV issue cost. Now don't forget what is in this format is PV of issue cost. It's not just issue cost. You now say PV of issue cost. But the only thing is that don't forget I told you are discounting your issue cost at year 2. So it's not a problem. But just put it there. So you now say PV cost at year 0. So you will now come here and say something like so you now say 0.88. Since it's year 0 now times 1.00. You are just doing the same thing. Since 1.0 is year 0 now, so you are just putting it there just for clarity sake, 0.88 million. So this PV of issue cost, no pass like this. If there was tax now, hey, but it doesn't say they have tax relief or anything. If they have tax relief, you would have come and reduced, you have come and charged their tax and reduced it from their tax. But since they don't have tax, you would you would continue from there. Oh, yeah. Now this is another place. This is another place that assumptions. This is another place that assumptions are allowed. These are assumptions are allowed. You can also still assume that. You can also still assume that your subsidy. Do you understand? Please listen to me. You can also still assume that your subsidy or your interest that you want to charge gross finance required or on gross finance raised. Are you listening to what I'm saying? You can still assume, or you might want to assume. It's part of the assumptions. They will tell you to write your assumptions now. Assume. So you can assume that you want to charge either your subsidy or your interest, so or either on the gross finance required or on the gross finance too. For this first question, I will charge it on gross finance required. On the second one, I will charge it on gross finance raised. So let's say, so you now see PV. PV. The next one is PV of interest, Abi. PV of interest. That's the first. That's the second one. So when you want to calculate your PV of interest, the first thing you would do is you will now say. You first say, what's that thing I tell you? Say, so let's just bring our total borrowing out first now. So you say total borrowing. What's that? I said I'm doing this one on finance required. So it is 42.97. If I wanted to do it on finance list, I would have used this one. That's what I'm saying. Your assumption. This is where your assumption comes in. You can decide to, if you want to do, but be very clear on what you are doing. If you're assuming that you want to do it on gross finance, put 43.85. But if you want to do it on gross finance required, put 42.97. Do you understand? He will give you different answers. But the answers will not, it's not as if they will be exactly so far off. He will give you different answers, but in your assumptions, please put them there. Please, do you understand? In your assumption, either they say state your assumptions or not, go and state it in your assumption that it was assumed that it was the gross finance required. You say that issue cost, it was assumed that issue cost was on gross finance raised. That's number one assumption. Number two, it was also assumed that interest and subsidy is on gross finance required. Do you know what I'm saying? It's just assumption. So this is the total borrowing. From there, you now say, so we are trying to calculate all our total interest, Abi. Trying to calculate our total interest. So let's calculate interest on. So what's the story about government and what they say about government and about you? They say government like the investment, Abi. We are.
Yield on treasury bill 2%.
That's the question I asked. I said, what is the story about government liking the
It is anticipated that the project will be financed entirely by debt, 60% of which will be obtained from a subsidized loan scheme run by the government, which lends money a rate of 100 basis points below 10-year-old government debt yield rate.
Hold on first. Hold on. Before we even go to that, the government, let's first calculate the amount that government is borrowing us first. Let's just calculate the total amount. 60%, Abi. So you say subsidy. Yes. So you say subsidized. You say subsidized. Don't forget that we are charging interest on the amount that government is borrowing us now. Let's know the amount first. So you say subsidized loan. So that's 60% times 42.97. What do I have? And you say normal loan.
5.78.
Cannot be 5 points now.
I said 25.
25.78.
25 points. Which one of them?
25.78.
60%.
25.78. What's this one?
17.90.
Okay, so this is the total amount that they are borrowing. So now let's go on. This is total borrowing. This is borrowing from them. So the next, let's go and calculate our interest. So you now say interest. Now say interest. So you say interest. So you say, so what's the subsidized rate? Subsidized rate. What do they say about the rate that the government is borrowing us?
1%.
100 basis points below 10-year-old government debt yield rate of 2.5. That is 1.5.
100 basis points.
Yes.
Below what?
Below
10-year government debt yield.
2.5.
2.5 is
Don't
the
give me
rate.
the answer. Read the grammar for me.
100 basis points below the 10 years government debt yield rate of 2.5%.
Of 2.5%. Good.
Yes,
now,
sir.
listen, for people that don't understand basis points, whenever they say 100 basis points or whatever basis point, just divide it by 100. They say 200 basis points, 200 basis point divided by 100. 300 basis points, 300 basis point divided by 100. It gives you 1%. Just what I'm saying. If they give you 200 basis points, they say 250 basis points. 250 basis points, if you want to convert it to spread, 250 basis points divided by 100, this should be 2.5, if I'm correct. That would be 2.5. That is 2.5%. So you now subtract 2.5% or add it to whatever they say you should add it to, or subtract it for whatever they say you should subtract it to. Mr. Maliki, was you that said I should explain basis point? I don't know if you've gotten me now. I don't know if he's even still here. Maliki, I don't know if you're here, but like it was you that told me to
Yes,
explain
I'm
basis.
here, sir. Thank you, sir. I got it now, sir. Thank you, sir.
So whatever basis point divided by 100. So this one, they said 100 basis points below Abi. So what will you not be? So that's 100 divided by 100. So what do I have? That's 1%. Now. So the answer is below the normal rate of 2.5%. So that's 2.5% minus 1. Now what do I now have?
1.25%.
So it means that government is borrowing you at 1.5% rate. You see that these things are easy. They are just trying to be smart. They're just trying to be smart. Nothing is there. So you now say normal interest. Sorry, let me change this to subsidized interest. Yeah, what do I have for this one? So this our normal interest of this one is what? What's their own rate? 17.19 times. What's their rate?
2.5.
2.5. Is that what is the question? The normal borrowing rate?
No.
1.5. That's not in the question now. 1.5K. They cannot be, you will be higher than this one now. They cannot be borrowing. Government is already subsidizing for them now. So it would obviously be more than this one. Yeah, would that.
So we don't want to give you poison. We are looking for it.
No, that is 150 is what?
Note 5.
Interest is based on equatorial normal borrowing rates of 150 basis points over the 10 years. That's 150 over 100. That's 1.5.
150 basis points above what? 1.5% above what?
Over the 10 years government yield rate.
Of what? What's the 10 years government yield rate?
2.5.
0.5.
Please, where did you see the
That's 100 divided by, that's 150 divided by 100, and that's 1.5. That's 1.5 plus 2.5 now. That's 1.5 plus 2.5. What do I have?
Correct, please. Thank you.
4%.
That's 4.
Yeah, what do I have?
English is too much.
They're just trying to be smart. There is nothing there. What do I have?
38.67 for the subsidized interest. 38.67.
But don't forget that it will not be now. I'm taking 4% of 17.19.
0.387. 0.387.
There are some figures that you press in exam, you know you are wrong. Please be very careful. Don't be rushing to write. You are taking 4% of 17.9. You cannot get 38.7 again. It should be lower.
Sir, I said it was for the subsidized interest.
It's for the first one.
Okay, the first one is what? Okay, this one is for the first one. Okay. What do I have for the second one?
0.69.
0.69.
What's the total? These are total interest, or these are net interest. That's when I said net interest. So these are net interest. What do I have?
1.07.
Work has finished now. So from here next now, what do you now do? According to that format that I gave you, after you got in your net interest, charge tax on it. now.
Net of tax.
So this is where you now do your tax saving. You now say tax. You now say tax saving. You say tax saving at 20%, which is equal to. So you now say 1.075 times 20%. What do I have? What do I have?
0.215.
0.215 million. So after this, what do you now do? PV.
Yes, please.
Do PV of tax saving 0.215 times so discount factor now annuity at 7.5 times. What do I have? At what? What's our cost of debt? What's our cost of debt in the question? Cost of debt. What's our cost of debt in the question? Would that our cost of debt? So
2%.
If you are sure, it cannot even be 2%. If you are sure it's 2%, if you are sure it's 4, then it's 4. It cannot be 2. And I don't have the question here. The person that said 2, read the 2 for me.
The 2% is
additional information 4. Equatorial uses either a nominal cost of capital of. Okay. Sorry.
You don't change your mind.
It's 1.5.
How do you know that it's 1.5?
Please, it's 4%. Because interest is based on, that's equatorial interest is based on 150 basis points over 10-year government rates, which is 1.5 plus 2.5, which is 4%.
Thank you. Yeah, thank you very much. They are 4%. They are do 4% annuity for 4 years. Is it 4 years or 5 years?
4 years. 3.626. 3.6.
3.63.
3.630.
For people that don't understand why we're using 4%, I told you that always discount this thing with your cost of debt. Cost of debt is the interest that you are paying on the debt. On the debt that you are doing. The debt that you are borrowing normally is for you cannot add the two together. Don't. This is a subsidized rate now, it's not your business. Cost of debt, which is the normal rate that you are borrowing, please. The cost of debt here. So you let me write it there. Say what is it? 3.63. 6. So you now say that is annuity of cost of debt of cost of debt of 4%. What do I have?
0.780.
What do I have?
0.78.
78 million. Yeah, so this is our interest now. So last one, let's go and do subsidy. So that this thing is not hard. If you follow that same step, it's the same thing. You get the net interest, charge tax on it, do your discount factor of it. See the same thing I told you. Then the last one, subsidy. So you say subsidy. So the first thing you do is first get the subsidized amount now. So what's subsidized amount? So you say subsidized loan. Subsidized loan. So that's 60%. You've gotten it up there. Don't forget.
25.
You say 60%.
25.78.
42.97. You said it's 25 point what?
78.
25 point what? 0.78.
78.
So how you gotten your subsidized number? You will now do tax savings on. You now do tax savings on subsidy. on subsidy, which is equals to your normal borrowing rate, minus your what? Minus your subsidized rate. So what I'm saying now is, so you're now going to do, so you say tax, no, it's not tax savings, so sorry. This one is just savings on subsidy. So you now say your SOS, which is your savings on subsidy. What's my normal borrowing rate? 4% minus 1.5.
1.5.
1.5%. So I have 2.5%, have you?
2.5.
So for me now, you now say what's my net subsidy? My net subsidy, which is equals to my subsidized amount, which is 25.78 post tax, 1 minus 0.20, Abi? 1 minus 0.20
Yes,
times your 2.5%. What do I have?
0.52.
0.52. Don't forget, this is not the end. You now do PV. Of subsidy. You do your PV of subsidy, which is equals to your net subsidy. Equals to your net subsidy times what now? Times your discount factor. That is at 4% annuity. So what do I have then? So you are saying
1.89.
PV of subsidy is equals to 0.52 times 3.630. What do I have?
1.89.
What do I have?
1.89.
1.89. See, it's not more than this. It's not more than this. It's as simple as this. So let's go and put these figures here. So the finance effect. I don't know. Okay. So what's our PV? What's our PV of issue cost? 0.88, Abi. What's our PV of tax savings on interest?
0. Okay.
0.78. Positive.
0.78. On subsidy. On subsidy.
1.89.
And 89. What do I have in total? So you see my PV of
1.79.
effects. I mean, the PV of financing effect. 1.79 positive, Abi?
Yes, please.
So let's take this and go and add it up to our base case MPV. You know, pass like that. This thing is no more than this. So you say, okay, so it's still up. So 1.76, 1.7.
1.79. Yes.
So what's our APV?
$12.46.
Correct.
12.46. Okay. So this is what it is. This is just the answer. This is just the answer of what we should have been. I'm trying to confirm something. 1.6. Okay. So I think I'm just trying to. So this is our APV now. So since it's positive, so what's our decision?
They should go ahead with the project since it's viable.
So this. So you say decision. So you can write your assumptions first, or you can write your decision. Please write your decision first before you write your assumptions, please. So you now say decision. The project is financially viable because it has a positive APV of 12 million 46 12 million 46 like this. Sorry. So this is what they ask you to do. So once you are not done, even if they did not ask you for assumption, you will not go and put assumption there. So the constant assumption, let me tell you the assumptions that are very constant in case they ask, in case even if they don't have, but the assumptions that are always very constant. The thing is, if they ask, you will list them. The assumptions that are very constant is your cash flow. You will tell them that you assume that the cash flow they give you that is realistic and it will occur at the end of the year. That one is a very constant cash. You use it as long as MPV, you can use it for anyone. So you would not the cash flows given to you, the cash flow estimates are realistic and will occur at the end of the year. That's one. Another one is you can always assume that you can also assume that debt issue costs, they are not tax deductible. It's not given to you now. Debt issue costs are not tax deductible. Another one that is constant. I'm telling you about the constant. Debt issue cost is not constant. It's just for APVO. And that's if they don't. Okay, let me tell you the one that are constant. Cash flow is constant, that is cash flow are realistic and will occur. Depreciation is also constant. Depreciation is ignored because it does not involve movement of cash. That one is also constant. Inflation is also constant. You say,
So
you assume
that's
that
our assignment too.
all inflated figures. And this one is not assumptions of APV. This one is not assumptions of this one is general assumptions that I'm telling you. You will not. This one will not be included in your assignment now. You will not put this one there. Don't put this one I've told you there.
Okay, sir.
Or let me
How many are there now? Don't say again, no. Don't say again, no.
Sir, please continue, please.
I don't stop. But I've given you three, I said cash flow, that the cash flows are correct, that the inflation figure are also correct, and depreciation, that depreciation does not involve or it does not include movement of cash. So that is the third assumption. So please do that assignment and also bring. Now, another assignment I want to give you before we most likely will meet by 9. So please be active. I might send you a link that will meet by 9 p.m. Let me go and do what I want to do now. If I finish on time, we might meet by 9. But if I don't, we'll see. You guys will see Mr. Timmy on Sunday. You most likely see another lecturer tomorrow. Yes, most likely. Let me tell you now. Most likely, I'm not so sure, but most likely another lecturer might come in for portfolio theory tomorrow because I don't have time tomorrow. But you see Mr. Timmy on Sunday. But you most likely will see me again tonight, 9. We'll do mergers and acquisition and business valuation. Even if it's just introduction, I am okay with it. But while waiting for me, the number 2 of that question, please solve it. Listen to me. Number 2 of that question, solve it. I think what's his name? I can't tell. I'm waiting with him. Solve that second question. And when you solve the other question, solve the second question. But this is the one I need there. I need you to do the base case MPV. Whenever I come to class, no matter when, I am not resolving the base case MPV. If at all I want to resolve anyone, it will be the PV of financing effect. Even if at all I want to resolve anyone, it will be. I cannot be solving base case MPV now. I've been doing MPV since how many decades ago. So if at all I'm going to solve anyone, it will be the PV of financing effect. But please solve the base case MPV again by yourself. So when I come back by 9, if at all, I can use the first 30 minutes to do the PV of financing effect, just to make sure people that did it are correct. Then I'll know that I'm done with APV. Yes, so I'll know I'm done with APV. So I'll just do the PV of financing effect. I'll know I'm done with APV. Then, but you guys should go and do the base case MPV. It's not different from anything you've been doing. Please, I hope that's fine. That's the only way we can move. This is already September. Only September. The only month that we have in between here now is just this September, because we should finish all classes by late September, because our revision will most likely be, say, mid of October. And like I told you guys from the very, very beginning, my plan this diet is I want to give students 2 weeks before we start revision. I want to give you guys 2 weeks to go and read first. So that when we come to revision, we are doing it together. It's not as if I'm starting to explain afresh. So I need to finish anything I want to do, say first week, highest second week of October. Highest second week of October. So that's the only way I can move. And we still have international capital budgeting. That's one I'm hoping we'll move into next week. But please solve that base case MPV. And also, if you solve that base case MPV and do the PV of financing, do everything, solve the whole question. But when we come, maybe by 9, by the grace of God, we'll look at it together again and see where you got it wrong, where you don't get it wrong. But before I go, please ask me any question. Is there any question?
Please send your solution, please.
Do we get the solution? Exactly.
So I will copy it, Abby.
No, to make the reading easy.
Yeah.
You so that you copy, but no one anything for you.
We appreciate you, sir.
Thank you, sir. The last one, please. The last one.
Sir, I have just a quick one.
Ask me a question.
I have a question. Hello, sir. Yeah, good evening, sir. Hello, sir.
Ask me.
Yes. How do we know that when they ask us there is a tax relief on issue costs? How do we know?
They will tell you now.
Mention of Okay.
They will say the debt issuer's tax relief. They'll tell you in the question.
Okay, sir. Thank you, sir.
You're welcome.
Sir, I have a question.
David, don't want to repeat the question. I've heard now. I'm telling you already. You don't need to unmute. I'm feeling the hand is up.
All right, thank you, sir. Because I'm having issues with the PV of interest, the area that has to do with subsidized interest and normal interest. My basic issue is basically how we got the 1.5% and how we got the 4.4%. Please, can you briefly explain that? Thank you.
The question says it's 100 basis points below the normal interest rate of 2.5. That's how we got it now. They said 100 basis points below 2.5. 100 basis points is 100 divided by 100. That's 1%. That's 1% minus 2.5%. That's 1.5. And the other one says 150 basis points above. First thing you first convert that basis point to spread. That is converted to percentage. That's what I mean by converted to spread. So 150 basis point to spread is 150 divided by 100. That's 1.5%. And it's 1.5% above the normal rate of 2.5. Above the normal rate. So 1.5 plus 2.5 gives you 4.
All right, sir. Thank you so much.
The other was 1 minus 2.5, give you 1.5.
All right, sir. Thank you.
You get it now, yeah?
Yes, I get it, sir.
Oh, yeah. Favor your question, please.
All right, sir. Please, for the relief on issue of the issue cost, how are we going to apply it as well?
The what?
Like the relief on the issue cost, how are we going to
explain earlier now when I was explaining the first one? When you see tax relief on, I explain from because I like to do introduction first. Once when they say tax relief on issue cost, the issue cost, the amount, this one was 0.88. Let's say they say the tax rate is. Why is everybody on muting now? Uju, Emmanuel, why are people on muting? I've muted you, are on muting again. What I'm saying is tax relief. So they will say tax relief of, let's say 20%. So you do the tax rate now. Say this. Let me do this one. The issue cost of this one was 0.88. So we just do 0.88 times, let's say, tax rate of 20% times 20% times the discount factor. Don't forget what you are doing. You are doing PV now. So you just say times this particular one, this same discount factor that we use now, but you just do year one. It's not going to be 4 years again. No. It's just going to be year one. So you just do 0.88 times. Let's assume the tax rate is 0.20 times the discount factor. That's 4% at year one. I don't know the discount factor, anyways. 4% at year one. Whatever you get after multiplying everything together, you now go and add it to your issue cost. Don't forget that your issue cost was in negative. So that is the tax rate that will now reduce that issue cost. Whatever you have is now your PV of issue cost.
Thank you, sir. Sir, please,
You're
my final question. You mentioned something about pilot questions. Please, how come will I get that question?
No. I just saw it. I don't even know where I found it. I just saw it somewhere. I'm sure it will get to you.
All right,
Just came out yesterday.
I have one. I can send it to the group.
But I'm sure
Thank you
over
very
time
much.
it would get to you. Anyways, in the absence of no question, please solve that question too. Let me go for my other engagement. Another meeting now. This life is tough. So, in the absence of no other question, enjoy your solution, enjoy your class, enjoy your assignment, enjoy your class. It's classwork, it's not even assignment because you are being in now. Now, as I come out, use the next 1 hour, 30 minutes to solve it. And I'll see you guys by 9 o'clock. Enjoy.
Sorry, Mr. Bola. I want to send the pilot's question, but only admin can send text to the group. Is it there?